Good afternoon. It's Jeff Christian, CPM Group. It's Friday, the 20th of August, about 3:35 in the afternoon. Running a little late today because it's been a pretty busy day. Silver, as some of you may know, has been testing $23 and it's broken below $23 a couple times so far today to sort of see if there's enough support, buying support to keep it above that or take it down maybe to 22. Got a long presentation we've prepared, and what we've done here is we've broken it into two parts. Some of you know that we did a video on Tuesday of this week to catch up with the markets and talk about some other things. And it's just a lot to talk about, and we're getting a lot of questions and answers. So we had 5 topics, subject areas. Interest rates and gold. I want to talk a little bit about that because I think it's going to be au courant next week. And then a market update, very short. And that's it for today. And we'll post that hopefully yet this afternoon. Then on Tuesday, we'll post the second part, which we'll be recording this afternoon. And we'll talk a little bit about of monetary history. The suspension of the official sector dollar gold convertibility on August 13th, 1971. And specifically, somebody said it was a surprise. I had criticized those people who call it the Nixon surprise, saying it wasn't a surprise to pretty much anybody. And one guy said it was a surprise to me. And he doubted that it was not a surprise to me. So we'll talk a little bit about why I said it wasn't a surprise. And that's going to be on Tuesday. We're also going to talk about companies holding cash reserves. I mean, there was the gold promoters and permabulls made a big deal about a company that has never turned a profit, putting $50 million of its cash reserves into gold, and how this was the start of something big. And we'll talk about, it's not the start of something big, it's something that companies have done actually for centuries. And they've been doing it in the last 20 years. So we'll talk a little bit about just what that has done and some aspects of it that could be interesting. And maybe some of the people who watch these videos might actually want to help CPM Group move those initiatives forward. And then we're getting a lot of questions and comments and responses. And we try to ignore the prepubescent ones, but there are a lot of legitimate questions and comments. A lot of the questions are questions that we've answered before, but I guess it bears repeating the answers since the answers may have been missed. So we'll go through some of the questions and answers that we've had recently in that second part. So let me start by talking about interest rates and gold. We've talked about it, and I'll talk about it in the next session. We expect that the gold and silver prices could fall next week. And the occasion that we're thinking is that there's going to be a lot of discussion about the state of the economy and the probability that the Federal Reserve Board starts moving away from as excessive monetary accommodation, if you want to call it excessive, as extensive monetary accommodation as they have been, to something less extensive, and that interest rates might actually rise some. And what we've seen several times this year is even the mildest comment about rising interest rates or the potential for interest rates to rise 2.5 years from now have led to outsized downward moves, gold and silver, and in the stock market. And next week we have the Kansas City Fed's annual Jackson Hole, used to be a barbecue, conference. And there's going to be a lot of talk, and there's going to be Fed economists and Fed governors and chairman of the state of some of the Federal Reserve banks and other non-Fed economists and monetary leaders talking, and they're going to be talking about the strength of the economy, the movement into an expansion phase in the United States and a recovery in Europe and elsewhere. They're going to be talking about the idea that interest rates might rise a little bit. And that may be the occasion for people to sell off gold and silver. Briefly, possibly down to, well, it could go to 1770 for gold, We're testing 1780 a couple times today, but we haven't broken below that. But quite frankly, and we've been saying this for some time, another spike down to 1680, the way we saw on the 6th and 9th of August, is not at all out of the question, given the amount of technical selling that could come into the market if gold pierces 1780, 1770 on a convincing basis. So it's not that the interest rates could drive the market down, but rather that market perceptions of interest rates could drive it down. Now, that said, we don't think that interest rates are going to rise so sharply anytime in the near future as to be a negative for gold and silver investment and investors and prices. And let me run through a couple numbers here on that. This is a chart of the most recent Fed dot plot. These are, each dot represents a member of the Federal Open Market Committee, where they think interest rates are going to be. And it's a dreadful chart, but it's the best available chart that we could find on short notice without making our own. This is 2021, 2022, 2023, and then longer term. And each dot represents an FOMC member's views. And you can see they all think that interest rates are going to be 25 bips today, this year. Well, they've been. That's an easy projection. Next year, most people think on the FOMC still think it's going to be 25 bips. There are 5 who think it could be 75 bips, and there are 2 people who think it could be 1.25% for the Fed funds rate. For 2023, it's spread, and there are those 2 guys who are worried here. They're up to, what is that now? This is such a terrible chart. They're up to this is actually 75 bips. And this is 1.75 bips. So those guys have gotten up to there for 2023. And most of them are still down here below 1%, 5 above 1%. Longer term, hey, sometime in the future after we've all retired and moved to suburban Virginia, most of them think it's going to be about 2.5%. There are a couple people who think it could get up to 3%. So the Fed doesn't expect interest rates to rise very sharply, even in the long term. And they've made comments to this extent. They've said that we have real inflation adjusted interest rates that are negative and have been negative since 2008 for all intents and purposes. So that's 13 years now. And the Fed has said, frankly, we wouldn't be surprised to see real interest rates on T-bills remain negative for the next 10 years. And that's something that we've written about, and other mainstream economists and people who actually understand finance have written about too. Now, this is important because if you compare reasonable market expectations as opposed to the arm-waving perma bulls to historical performance, you can see the relationship between real interest rates on T-bill level and gold price changes. And you can see that negative interest rates, even 0 interest rates, even 1% interest rates on a real inflation adjusted basis, generally speaking, are correlated or have been correlated for the last half century with rising gold prices. This is real rates. If you say 2% as your nominal inflation rate, so you're talking about 3% nominal rates. If you're using 4% inflation, you're talking about 5% real nominal rates. So you're talking about interest rates that are higher than anyone at the Fed expects. And quite frankly, most people expect for the foreseeable future. It's only when you get real inflation adjusted T-bill rates over 3% that you start seeing investors saying, I can get 3% adjusted for inflation in T-bills. Why am I owning gold? So it's only when you see 3% real interest rates over the last half century that you found investors saying, based on this, I would not buy gold. There are other factors that can intervene and cause investors to want to buy gold. But in terms of interest rates, real interest rates are not a threat to gold investment demand, investors, or prices until they get over 3%. So you're talking about 5 to 7% nominal rates. And the Fed thinks, hey, in the long run, it might get up to 2.5%. So we don't see interest rates being problematic for gold. We do think that market perceptions of interest rates can be problematic for gold. So market update. Gold prices fell off in early August as we had expected them to. They got down to 1680 briefly, 1677 briefly. They have been trading in a very narrow range of really 1780 to 1800 over the last 2 weeks. They've been unable to break below 1780 and unable to really break above 1800. There are a lot of buy and sell orders on either side of that range. So if the price breaks forcefully below 1780, you'll see fresh sell orders by speculators thinking the price could fall sharply. And you'll see stop loss orders by people who have long positions. They want to get out of them because they think the price could fall. If the price rises above 1800, you'll see a number of buy orders cascaded. Fresh long orders from investors who think that if it breaks above 1800, it's going to 1820 or 1840 or maybe even higher. And stop loss orders on the shorts that are in the market. And I'll talk about this in the Tuesday thing because a lot of the people keep thinking that when you see 4 million ounces of gold sold in a 10-minute period, that it's one actor. And it's not. It's hundreds of actors, hundreds of independent, mostly investors, everything from large hedge funds to smaller funds to individual investors, trading off of the price, using technical analysis, in many cases using the same computer programs that say, if the price falls below 1780, sell. And you see this over and over again, and you see this in the market. So, one of the questions, I'll just jump ahead to Tuesday. Well, the question says, well, who sells 4 million ounces? No one does, but collectively, several hundred people do. And the other question is, where do you see, how can you possibly explain the idea that gold could go from 1780 to 1680 in one day and then back up to 1770? Well, the same way I explain the sharp decline in the S&P on Wednesday and the recovery of 75% of that decline on Thursday morning. And countless other times when that happens. But I'm getting ahead of myself. That's next week. That's Tuesday's presentation discussion. And it's just the way markets are. And the fact that people refuse to believe it is their problem. It's not the market's problem. Well, it is the market's problem because they stand in the bus lane. So our expectation is that gold prices still are vulnerable on the downside. Next week, possibly into early September. There's a lot of disenchanted investors, as I've said. We've seen that, people who bought gold on the way up to $2,000 a year ago, and they've been disappointed because it's not $10,000. And gee, all those guys out there were promising that it was going to be. And I see just this afternoon, one of them came back on YouTube with the thing, really, it's going to 10,000. Believe me, any moment. So there's a lot of people who said, life's too short to listen to those guys. Silver is a very similar situation. It's a little bit more tenuous. Silver has been trading in a very narrow range, $23, $24 an ounce since it sold off on August 9th. It's a little bit more vulnerable to a spike down, but a spike down is probably $22. And as we've been telling our clients for about 9 months now, if you see $22 silver in August of 2021 or 1680 gold, that's probably a great place to pick up some bargain metal as a long-term investor. And if the prices don't spike down and gold stays at 1780 or 1784 as it is right now, and silver stays at 23, those are good prices to buy at in a long-term basis too. think a few weeks ago, I was talking about central bank gold. And one of the things that we've seen since March is a number of central banks, maybe 10 or 12 of them, buying unusually large volumes of gold are in that 1780 to 1840 range, signaling to the market that they think that that is a good price at which to buy gold as a long-term investment. The other thing I wanted to talk a little bit about is platinum. We have been saying for some time that we thought, we had been saying that we thought that platinum would break above 1,000. It did. We thought it would trade in this range of $1,035 to $1,200 for much of this year. It did. It broke below $1,035 in early August. It broke below 1,000 shortly thereafter, and it's been trading below 1,000. We like platinum on a long-term basis, especially the 3 to 5 to 10-year period. We think that platinum is a very interesting investment. We've noticed that it has been gathering a lot of attention from at least retailers and wholesalers to investors, both institutional investors and to retail investors. Platinum's time seems to be coming. It's got strong fundamentals going for it in terms of rising fabrication demand from the auto industry. And I think that there are a number of factors that are actually long-term positive for platinum use in the auto industry. Palladium has been at record prices for a decade, and it's risen to higher record prices earlier this year. It's come off a little bit. We have been saying that we thought it would plateau somewhere above 20, well, at one point it was 2,500 that we thought it would plateau around. Then it was around 2,700 that we thought it would plateau around. Let's just say that we think that palladium could plateau above 2,000. We're not necessarily enthusiastic about buying more palladium at these prices. We would not advise anybody to do a platinum palladium trade, ratio trade, where they're selling palladium and buying platinum. I think platinum makes sense to buy, but I wouldn't pay for it by selling palladium, because platinum is going to play catch up after a couple decades of lagging. It's really only been about 14 years. Just because platinum is going to play catch up doesn't mean that palladium is going to fall. So I wouldn't be a short of palladium, but I probably am interested, or no, I definitely am interested in palladium on a long-term basis. Now, I think I mentioned that I was going to be out of town early next week. We'll do this video, we'll record it today for Tuesday. I will be around. I am planning still to be back on the 25th, Wednesday, the 25th of August. And we were planning to do an open forum, but my colleagues have convinced me we should roll it to the 1st of September, a week from Wednesday, to give ourselves more time to plan. And I guess they think in case I am enjoying myself too much on vacation and decide to take an extra day or two, it gives us a little leeway there. That's all I have for now. We'll be coming back with another video on Tuesday, and then I'll be back with another video the following Friday. Thank you, take care, have fun, stay cool.